Peace be upon you. Welcome back to Wealth and Wisdom. Money is supposed to be a communication tool. You would not want fluctuations in the tool that you use to communicate the value of things. A monetary medium with the lowest rate of change is most effective in communicating economic signals, and a fixed supply, zero rate of change, is the optimal monetary policy endgame. While the modern mainstream academia disagrees with this view, a fixed supply currency is superior to a currency that increases in supply over time, and at unpredictable rates. In any economy, supply and demand for goods and services relative to the supply and demand of money dictates prices. Price is what ultimately coordinates economic activity, and money is the foundation of the pricing mechanism within an economy. A currency with a fixed supply would remove the noise created by changes to the money supply in the price system, thus creating more reliable market signals. Because a monetary good facilitates the exchange between goods used for the purpose of either consumption or production, the form of money with the lowest rate of change will most accurately reflect changes in supply and demand of all other goods. Essentially, money is used to communicate the relative value of other goods and services, and changes in the money supply distort the communication of this information by introducing an extraneous variable to the equation. Here is another way to understand it. The value of money is the meter stick that we use in understanding economics. If the meter stick keeps changing according to the whim of other human beings, how could we possibly build anything? Nothing would fit in place because the meter stick kept changing size during the building process. This is how to understand the role of money in a society. You cannot have good money if the value of money keeps changing, according to the interest rates. Our economic foundations will be extremely flawed under such a system. In fact, it would be a broken system. Here is another way of putting it into perspective. Let's say an iPhone costs approximately $1,000, whereas a barrel of oil costs approximately $50. The information communicated through a monetary medium is that an iPhone costs approximately 20 times more than a barrel of oil. Money communicates opportunity cost, economic trade-offs, through its price system, and the more constant the quantity of money, lower rate of change, the more reliable the communication of information and economic trade-offs. If the money supply increased by 10% and prices adjusted equally, an iPhone would cost $1,100 and a barrel oil would cost $55. An iPhone would still cost 20 times more than a barrel of oil, and that is the relevant information which all market participants rely upon. In the real world, the problem is that prices do not adjust equally as the money supply changes. Instead, price signals become distorted. In a world with a constant money supply, changes in price would more accurately reflect changes in supply and demand in underlying markets for goods and services rather than also reflecting the unequal impact of a changing money supply. Changes in the money supply create noise extraneous to the underlying economic activity. Price coordinates economic trade-offs, and the reliability of a pricing system is dependent on the stability of the form of money used to communicate information. In that regard, monetary goods are differentiated, at least those that emerge on the free market. It is why money is an effective communication tool. The market structure for money is different than that of all other goods. A consumption good is consumed and a production good is ultimately consumed in the production of other consumption goods. Whereas, the utility of money is in exchange. It is functional in the coordination of trade by and between consumption and production goods, rather than being consumed itself. Because the utility of money is in exchange, scarcity is more important than the nominal amount of money in an economy. As demand for money increases and as its price rises, there is not a commensurate supply response because of natural supply constraints. The same is not true for any individual good or service. The relative supply constraint of money is what allows it to communicate relative value between other goods and services. Consumption goods and production goods can be substituted for each other, but money facilitates virtually all exchange between all other goods. The value of a money may fluctuate relative to goods and services, but relative scarcity of a money supply allows price to be communicated in terms of the money itself. Prior to Bitcoin, no form of money was finitely scarce. Bitcoin has a fixed supply, capped at 21 million. Finite scarcity creates a constant where none existed previously. Imagine the supply of one good being perfectly constant while the supply of all other goods fluctuates. Demand for all goods changes, but only one constant exists: the supply of Bitcoin. In this world, everything would be measured against the constant. The purchasing power of money would communicate far more perfect information through this pricing mechanism than if the supply of the money itself were changing. By creating one constant, everything else can be more reliably measured. And the desired information is not the absolute value of any one good. All value is subjective. Instead, the critical information communicated through a pricing mechanism is the relative value, or relative price, of many goods to each other. While price levels are ever changing due to constantly shifting supply and demand, the stability of the pricing mechanism itself allows for economic coordination via the communication of opportunity cost. Compare this to our current economic system. The supply of money changes unpredictably and increases over time. This is core to the central banking monetary model, and it derives from corrupt economic theory which argues that an active management of the money supply stimulates aggregate demand and ultimately promotes full employment. What it technically does is manipulate interest rates downward by increasing the supply of money. Lower interest rates increase the willingness and incentive to borrow. However, all else being equal, a lower interest would otherwise decrease the willingness to lend. Essentially, by inflating the money supply, the central bank artificially manipulates the function of credit, creating a sustained imbalance between the incentive to borrow and the willingness to lend. The more pervasive consequence is the distortion of the pricing mechanism that coordinates economic activity. By manipulating the supply of money and the supply of credit, central banks distort all prices throughout the market. False signals, and bad information, are distributed to all market participants. Check out our other videos where we have talked in great length about the central bank boom and busts created by money printing. If you learned something today, help out our channel by liking and subscribing. Until next time, Assalamu alaikum.